Inflation is starting to go away. That's the whole point of why the Fed was raising interest rates in the first place. There's signs that they're probably going to start pausing rates here pretty soon. And yet the ultimate index that is highly correlated to mortgage rates, is considered the ultimate pulse of the bond market, and ultimately really impacts the stock market, just keeps going up and up and up. Today we're breaking down why you should care about the yield on a 10-year treasury, how it impacts your life, and why it keeps going up with seemingly no end in sight. You don't want to miss it. Hey everyone, this is John Boyd, host of the Emerging Wealth Podcast. Thanks for joining us and making us a part of your week. Before we dive in, if you're finding value in our content, please give us a like. This helps us reach more listeners and share quality financial education. Next, I'd recommend visiting our website at www.modernwealth.com. Head on over to our Learning Center. It's packed with videos and articles designed to help you optimize your wealth. While you're there, consider subscribing to our newsletter. Thanks again for being with us. Now let's dive into this week's episode. How you doing, guys? Welcome back to another episode of the Emerging Wealth Podcast. Thanks for being here. Thanks for listening wherever you are, whether that be in the kitchen, on a treadmill, in the car, wherever it is. Thank you so much for being here. We got a good one for you. So, the 10-year treasury, in my opinion, is arguably the most important index you should care about. It's not the S&P 500. It's not the NASDAQ. Heck, it's not even what the Fed funds rate is. It's the 10-year treasury. The interest rate on a 10-year treasury really sets the tone for, one could argue, the entire financial system. And when it's unstable and shooting straight up like a rocket ship, you should know about it. So let's break it all down. So first and foremost, I think a little background is important. So as most of you know, the US government spends money like crazy. For 2023, the national deficit is anticipated to be around $1.5 trillion. That's trillion dollars. It's anticipated to be over $2 trillion in the near future. Now, at some point, it has always been known that this would come back and bite us in the butt in some way. Spending money like crazy, and what's happening right now with the 10-year treasury is an example of that. In order to fund everything from Social Security to infrastructure projects and everything in between, the government raises money through treasuries. Treasuries are very simply IOUs or bonds. The government gets money from investors globally, and in return, they pay them a stated interest rate. When the US is spending money like crazy and has a large deficit, we as a result increase the auction size of treasuries. In other words, we're trying to get more money to fund our spending. So keep all that in the back of your head because it's going to be important in a moment. The second big thing that you need to know about why rates won't stop rising is our battle with inflation. One of the jobs of the Federal Reserve is to ensure price stability. They don't want inflation to have long-term impacts on our economy. When you look at other countries worldwide who have very poor economies and are notorious for it, one of the common themes that they all have is that they don't manage inflation well, and it ultimately has serious consequences on their economy. So the Federal Reserve understands that the cost of losing the battle to inflation is extremely high. So what they do is they raise the Fed funds rate in an effort to promote price stability. Because when rates are higher, generally prices are lower. So let's tie all this together. Interest rates, the further you go out in maturity, the more yields are determined by supply and demand. Let me say that again. Interest rates, the further you go out in maturity, the more yields are going to be determined by supply and demand versus what the Fed is doing. So for example, the interest rate on a money market fund or a 3-month T-bill is going to be, for the most part, directly correlated with what the Federal Reserve does. So if the Feds raise interest rates 25 basis points or 0.25%, then the interest rate on a money market fund will go up almost in lockstep with what the Fed just did. However, the yield on a 10-year treasury is all about supply and demand. So to help you understand this better, I want you to pretend that you are running a multi-billion-dollar sovereign wealth fund. Your job is to go buy safe investments for this fund. So you go shop the number one bond market in the world, and that's the market for US Treasuries. Now, when you're doing this, you're faced with a dilemma. Do I buy T-bills where the annualized interest rate is 5.5% and I get my money back in a couple months? Or do I buy, let's say, a 10-year treasury at 4.6% and my money is locked up for a decade? Oh, and by the way, if 10-year treasuries a month from now are going for 5% instead of 4.6%, if I try to sell that 4.6% treasury that I bought, I'm probably going to lose money. So with that in mind, which one of those would you pick? A lot of you are probably thinking, well, shoot, I'm just going to pick that 5.5%, 3-month T-bill rather than that 10-year treasury. I get my money back pretty quick. There's essentially no duration risk, and rates might be higher in the future. So why would I tie up my money for 10 years? Give me that 3-month treasury all day. If that's what you are thinking, that's a huge reason why rates on longer dated treasuries are going up. When you combine the fact that the US government is trying to raise money due to the size of the federal deficit through treasuries, there's essentially a supply and demand problem that ensues. We need to raise money, but no investors want to bite at buying long-term debt from us because they can just simply buy a 3-month treasury at 5.5%. So in order for these investors to be convinced to buy a longer-term debt, the interest rate on 10-year treasury has to inevitably go up. And that is why we are seeing the 10-year increase the way it has been. Eventually, the 10-year is going to hit a point where the guaranteed interest rate is going to be considered really attractive. What that number is, we don't know yet. But clearly, the Fed's intention to keep the Fed funds rate higher for longer is having some impacts on all this. Now, at some point, that will change. If the interest rate on a 10-year treasury is, let's say, 5%, and you can get a guaranteed rate of interest, 5% every year for 10 years with no risk, a lot of investors may start to find that to be an attractive proposition. I mean, think about all the retirees out there that might think that's an extremely good deal. Think about all the pension funds and sovereign wealth funds that are out there that might want to sleeve in a part of their portfolio a stable and guaranteed investment at 5%. Again, at some point, that interest rate on a 10-year treasury is going to be perceived as a good deal. But for now, that's a tougher pill to swallow. So again, guys, I know that this is a complex topic. I know that we could easily turn this episode into an hour-and-a-half economics podcast, but that's not my intention, right? I just want you guys to get a high-level idea of what's going on here. So now that you hopefully understand why the yield on a 10-year treasury just keeps going up, let's talk about how it directly impacts your life. Because quite frankly, that's all that matters. So here are just a few ways the yield on a 10-year treasury really impact your life. So number one, the 10-year treasury and what a 30-year fixed mortgage is are extremely correlated. Go look at a chart of a 30-year fixed mortgage and a 10-year treasury side by side, and you will see they move practically in lockstep with each other. One major reason for this are mortgage-backed securities. Mortgage-backed securities are a type of security that are backed by a pool of mortgages. Mortgage-backed securities are one of the most important types of assets that investors globally buy and sell. Now, the 10-year treasury yield is a benchmark for the pricing of mortgage-backed securities. This means that when the 10-year treasury yield goes up, the yields on mortgage-backed securities also tend to go up. And when the yields on mortgage-backed securities go up, guess what also goes up? Mortgage rates. So if you're someone interested in buying real estate anytime in the near future, I would be looking at what's happening with the 10-year treasury, because that is going to tell you a lot about what could potentially happen with mortgage rates. Second big way the 10-year treasury impacts your life are with stocks. If the long-term average return for a globally diversified stock portfolio is, let's call it 8% per year, and you can get, let's say, 5% on a 10-year treasury, how many people do you think are going to take the 5% treasury with zero risk if you hold it to maturity? A lot of people will. A lot of multi-billion dollar fund managers worldwide would like in on that type of action. And as a result, stocks tend to get sold off. And what tends to get sold off first are stocks with more stretched valuation, stocks that are more in growth mode, that are considered less safe, tend to get impacted. This is why stocks and interest rates historically have shown a negative correlation. When rates are higher, stock prices should in theory be lower and vice versa. So given all this information about rates, what should you do? Let me make this abundantly clear. This isn't supposed to be some Fox News type of segment that's talking about how rates are going to keep going up and up and up, and therefore the US dollar is eventually going to collapse, and that we're all going to be using gold as a standard currency moving forward, and how we should prepare for a multi-decade period of economic doom. That is not what I'm saying at all. However, it's important to know that we've just come out of an era of historically low interest rates, a super easy stock market as a result, and virtually no inflation. Now we're reverting back to more historical norms. That is all that is happening. And as a result, it's scary for a lot of people who perhaps started investing seriously in a post-2008 recession type of environment. So if you're trying to build wealth in this environment that is reverting back to more historical norms, and in an environment where rates may continue to increase, here's what you need to consider. If you're saving up for a home, understand that the days of a 3% mortgage may not be coming back anytime soon. Some may argue that those levels may never come back during our lifetime. As a result, you may need a larger down payment to have a more manageable monthly payment. So review your budget, look at how you're saving, and see what your goals are so that you can prepare accordingly. That might mean saving a different way. That might mean putting more cash away for those goals. Whatever it may be, you might have to make some adjustments. Number 2, look at your portfolio composition. So most investors' due diligence process on an investment is to simply look at a 10-year performance chart and pick stocks and funds that have done well over the last 10 years. The problem with this is that the last 10 years was in a completely different era than we are now. I mean, interest rates alone are in a completely different place than they have been really for the last 10 years. So you need to keep that in mind as the playbook for stocks may look different. Finally, you need to strike a balance with having liquidity on your balance sheet and having good forms of debt that will allow you to leverage and magnify your wealth. Good example of that is with mortgages. Go on a place like Reddit and the generic advice is to pay off your mortgage because it's like locking in a guaranteed rate of return of 7%. But the problem with that is that mortgages are now technically at around historically normal levels. People for decades have made tons of money understanding how leverage works, taking advantage of tax benefits associated with mortgages, and giving themselves some breathing room by not tying up all their wealth in illiquid assets. So you need to know how to strike that balance between how much debt to have, good debt, versus how much to have liquid. Bottom line, guys, money is to be made when rates are higher. The playbook might look a little different, but it doesn't mean the sky is falling. If you need help navigating this interest rate environment and want to know how to optimize your balance sheet, your portfolio, or financial plan given these circumstances, reach out to us, www.modernwealth.com. That's modern spelled with no vowels, wealth. We'd love to help you out. Again, everything on today's podcast was financial education only. If you need specific advice, please reach out to a fiduciary advisor to help you out, like Modern Wealth. This has been a lot of fun, guys. Thanks for tuning in, and I will see you next time.